Let's be real here, some of us are looking to retire early and live completely off our dividend income. But with most of the traditional ways of investing into dividend-paying stocks or ETFs, the normal path of retirement, even for those investors that have a significant income, could literally take decades. Now, if you've ever dreamed of retiring early, and I mean very early, then stay tuned because we are going to go over what might be literally one of the fastest ways to retire early and live completely off of dividends. And this is a newer method that not even all that many dividend investors are aware of. So make sure to stick around because we are going to go through all this and more. Right after you, please drop a like in this video and subscribe for more future content like this. So the method we're talking about in this video to retire early is to buy shares of ticker symbol TSLY or the YieldMax Tesla Option Income Strategy ETF. Now right here on the YieldMax ETF website, you can see there's many different YieldMax ETFs, but they all have pretty much the same strategy. They buy shares of whatever the ETF tracks and then sells covered calls in them and earns a boatload of premium for doing so. And I am talking about an insane amount of premium. For example, looking into the TSLY distribution rate, as of 8/11, it is 66.63%. That is the actual dividend yield, 66+%. Now, before we go over the exact math and show you all how any investor in theory could retire quite early with a small amount of money invested, relatively speaking, let's first dig a little bit deeper into the YieldMax TSLY ETF and explain exactly how it works. The fund overview says the YieldMax TSLA Option Income Strategy ETF, or TSLY, is an actively managed fund that seeks to generate income by selling or writing call options on Tesla. TSLY pursues a strategy that aims to harvest compelling yields while retaining capped participation in the price gains of Tesla. Now, some more important facts for TSLY specifically. TSLY has a gross expense ratio of 0.99%, which is definitely higher than that of most other ETFs out there, but for an ETF with this type of strategy, it sort of makes sense. The net assets are already up to $425.8 million. And I say already because I've been tracking this ETF for quite some time now, and the net assets have been going up very, very quickly. Now, TSLY was started back in November of last year, so there is a little bit of track record, which we're going to go through here and show you in a second, to see how this fund has actually performed since inception, and of course, how the dividends have looked. So I know what you're probably asking next, how in the world do these covered call ETFs from YieldMax even work? And how are they able to generate such massive distributions for investors? Well, first of all, let's go over some of the basics of a covered call strategy. For those that might not be aware of it, covered calls involve buying shares of a stock and then writing call option contracts on some of those shares. A covered call could also be referred to as call writing or writing a call option on a security. And for beginners out there, it's going to be a little bit confusing because there are different terminology and different ways to say the same thing. For example, if you want to sell a covered call, you could also say that I'm looking to sell an option. There's many different ways to say it, but they all pretty much mean the same thing. So other investors can then purchase the call option that the sellers are of course selling to them. Now for the contract buyers, they pay a small fee, or in the case of Tesla, Apple, and some of these names that YieldMax uses, sometimes a larger fee to the call writer, known as the premium for doing so. Now the contract gives the buyer of the option the right, but not the obligation to buy shares at a specific price on or before a specified date. In the case of call options, when the share price of the underlying security rises above the strike price that is agreed upon, an option holder can choose to exercise the option, at which point the stock could be called away from the person who wrote the call option or that sold the call option. Now the whole point of this is then the option holder then receives shares at a cost lower than the current market value, and that's sort of the value of buying call options. Their profits will equal the difference between the option strike price of what they agreed upon and where the stock is currently trading minus the premium paid. The higher the stock price rises before the expiration date, the greater the profit for the person holding the call option could be. Because the call option writer receives the income on the deal in the form of a premium, they want the stock price to either stay flat or fall or slightly rise in order to basically keep their shares, but also, of course, make some massive profit off the premium. So now that we know a little bit about what a covered call is and how it really works, when it comes to the YieldMax covered call ETFs, the ETF strategy is going to usually involve a short-term expiration date, say a month or two, and then the fund is going to buy a boatload of whatever stock of whatever YieldMax ETF you're choosing. For TSLY, for example, they're going to buy a ton of Tesla shares. Then after buying the Tesla shares, they are going to sell covered calls or write call options. And of course, like you learned a second ago, by doing so, they are going to earn a massive amount of premium. And a side note, the premium is going to be so high because all the different stocks that YieldMax tracks have a relatively high beta. So the premiums are going to be very, very high, which means more and more premium or more and more income for the ETFs, and then of course for the yield max ETFs shareholders. Now, after they buy the shares of Tesla, Apple, Nvidia, whatever it is, they sell the covered call, then you have to wait and see how the market's going to perform within the time period from then until the expiration date. If the shares move up like crazy, well past the strike price. Well, because writing covered calls gives you a profit cap, if you will. The funds are likely going to perform a little bit worse if that happens. But if in theory these names trade somewhat sideways, within the time that they execute the trades up until expiration date, well then the profits will be massive and also the distributions will too. So now that you understand exactly how the TSLY Yield Max ETF actually works, looking at the performance and the share price of TSLY as of right now, TSLY is currently trading at $14.97. So to acquire each share of this, you're going to just spend around $15 or so. And this is important because we're going to go over the exact math here in a second. Now, looking at TSLY's dividends that have been paid since the fund's inception, as of this month, we have an 83-cent dividend. Last month, $1.07. The month before that, 80 cents. The month before that, 44 cents. And then 83, 90, 90, and $1. So ever since inception, TSLY has performed overall very, very well. Now, one of the most shocking metrics, maybe, is the fact that if you look at TSLY's total return year to date, TSLY has returned almost 72% year to date. Now, of course, this is not because of TSLY's massive capital appreciation of the ETF price. It's, of course, because the massive dividends that TSLY has paid since the start of this year. So now that you know exactly which ETF we're talking about, exactly how it works, and you have an idea of how it's performed and how much it's paid since inception, let me go through the exact math and show you exactly how much TSLY in theory an investor would need to buy in order to completely live free and clear off the dividends. So this right here from SoFi.com says that the average cost of living in Florida, for example, and keep in mind wherever you live is going to have a different average cost of living, but I'm just using Florida for this example, is around $50,689 per year. So that's the amount of money an investor would need to be paid out per year from dividends in theory to completely cover everything, all the bills and all their living expenses on a yearly basis. Now, once again, remember, everyone has a different amount of living expenses. This is just an example, and I definitely implore you to go through your own budget and see what it would look like for you. But heading over to the calculator, the first thing we're going to need to do is to figure out how much on a monthly basis we're going to need to come up with to pay all of our bills, in theory, of course. $51,000, which is how much we need around per year to cover all of our living expenses, divided by 12, means that in theory, an investor would need around $4,250 per month ongoingly to cover all their expenses with just dividends paid from TSLY. Now, last month, TSLY paid 83 cents per share as far as dividends, and of course, the dividends paid by TSLY because of the fund strategy like we explained earlier. But regardless, just going off of this last dividend payout of 83 cents, this means that in theory, an investor would need to have 5,120 shares of TSLY in order to have enough shares where the living expenses is completely covered by the dividend. TSLY is currently just under $15 per share. So what we would do then is multiply 5,120 times 15, which is the price of TSLY, which gives us just under $77,000 invested into TSLY is all an investor in theory would need to completely live free and clear off the dividends. Now let's be real here for a second. Would I personally invest $77,000 in TSLY or any of the yield max ETFs for that matter and try to live free and clear off the dividends? Now for me personally and my risk tolerance, that's never something that I personally would do. But for me personally, over the last month or two, I have been buying some shares of TSLY, APLY, and I might buy some of these other ones very soon here, just in small amounts, just to watch closely on how they perform moving forward because these covered call ETFs definitely have my attention and some of these ETFs have had massive performance, at least year to date. But I want to hear from you guys down below when it comes to investing into super high yielding ETFs like the yield max ETFs. Is this something that you would add in your portfolio? Comment down below yes or no and tell us why or why not. If you enjoyed this video, make sure to please drop a like down below and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.